Overall,
about
an
right.
optimistic group, though about a quarter of them see something coming that maybe they don't like.
No, that makes sense. I'd be actually more scared if everyone agreed.
Okay, see if you can share now, Matthew.
Oh, look at that. Now, hopefully you can see a screen.
Yes, we can.
Yay.
Just to kick it off, for those of you who don't know me, my name's Nate Scott. I am one of your many hosts tonight. I own, along with my brother Josh Scott, who's on the call, probably my sister Megan O'Brien may be here as well, and my father Jim Scott. We own the Anacortes, the Arlington, Mount Vernon, and Cedro Woolley Windermere offices. We've teamed up once again this year with Jim Rowley and Dan Peterson, who have the Marysville Windermere office, and the six of us, along with about 150 agents in those 5 offices, have pitched in to put this on and bring you Matthew Gardner to talk about the Skagit and Snohomish real estate market. Matthew is Windermere's chief economist. I think we were the first real estate company to hire a full-time economist to help us understand the market, know what's happening now and what's going to happen in the future. Matthew's got a great crystal ball. And besides being the chief economist for Windermere, Matthew also sits on the Washington State Governor's Council of Economic Advisors. He chairs the board of trustees at the Washington Center for Real Estate Research at UW, and is also an advisory board member at the Runstad Center for Real Estate Studies, also at UW. So perhaps that offers a few clues as to who he roots for when Apple Cup's here. In any case, I want to turn it over to Matthew Gardner. Take it away, Matthew. Tell us what's going to happen in Skagit and Snohomish County.
I will do my best. Thank you, Nate. Yes, a dog, although I got my undergrad in Oxford, so I'm still an Oxford man, irrespective. But thank you all for joining me tonight. I know, excuse me, almost 2 years into COVID. We're getting pretty bored with this whole Zoom thing, and Zoom fatigue is setting in. So I do appreciate you taking time out of your busy schedules tonight to listen to this old English economist wax poetic about the economy and the housing market. But there's a lot to get through, so I'm not going to pontificate much longer. It is still important to talk about the country as a whole before we start distilling it down to what's going on in our region. And economic growth is fascinating. How do we define growth? GDP, the value of goods and services we create as a nation. If you look on the far left, when COVID-19 hit, we saw the biggest contraction in economic activity in modern history, at least American modern history. That was then followed by the biggest expansion. The Q4 numbers were remarkable. I mean, 7% growth, very, very, very solid. It is going to be a bit dour in Q1. Thank you, Omicron. But the bottom line is we are not going to see, I'm saying not expecting to see any recession in the foreseeable future. What's interesting about it is that we actually had a recession. Everyone ignored it. First 2 quarters, 2 negative quarters of growth equals recession. We had it. Everyone was far too worried about other things. And so I think we really saw a reset in terms of the economy. And going forward, probably about 3.5% growth this year, 2.6 next year. That is still well above the long-term average. So all things being equal, and there are a few things I'll be talking about momentarily, which might push that or change that. We're going to continue to grow as we move out of the COVID-19 period, as the pandemic becomes an endemic. And I'm hopeful that as long as we don't see many more variants, that we should be heading, or we are going to continue to head in the right direction. As far as the labor market goes, the top chart, I mean, we added, what, 467,000 jobs in January. Big number, very big number. In fact, my forecast was for 200, and my friends at Morgan Stanley thought we were going to see a contraction of 250,000 jobs. So it is doing better, but I'm an economist. I love doing indexes. So the bottom chart you see is an index which compares the change in jobs during COVID-19 and compares that directly to what happened through the financial crisis. It took us 76 months to recover all the jobs that were lost back then. We're doing clearly a lot better. It could be faster, but there's a bit of an issue going on, which is rather unique. There's a lot of job openings. Historically, about just shy of 5 million job openings at any one time in the country. There's more than almost 11 million job openings in the country. So what you do is, if you look at the number of unemployed people, relate that to the number of job openings, that should give you a good idea what's going on. Right now, there's 4.6 million more job openings in the country than there are unemployed people. It's a very disconcerting situation as far as I can see. And what's going on there? Several things. One, people who are getting close to retirement when COVID-19 kicked in, retired. They went away. The younger generation, all of a sudden, they couldn't figure out what they wanted to do. And for the longest time, they decided to sit back, take those enhanced unemployment benefits and really not go back to work. And it has become, because of this, a very, very tight labor market. And that's doing a positive, which is quite simply, it's pushing up wages, because people need to be, to get back to work, you've got to show them the money. And that's certainly very applicable in blue collar industries. In the white collar industries, we're seeing significant wage growth as well. And those professional business services, those kinds of entities, they want to keep the good employees they have, but they need to attract new ones. So in aggregate, we'll probably see wages increase by probably 4.5% to possibly 5% this year. Now, leisure and hospitality hit the hardest, but we've already seen 10% year-over-year wage increases in that sector. And my forecast, explaining this, that Q1 number of 397, that means we should have added an average of 397,000 jobs per month in that quarter. And if these numbers are accurate, well, it tells me that we should have recovered all the jobs lost due to COVID by the end of this year. And that can sound great, but the trouble is we've lost a lot already because we weren't growing the way we should be, just recovering. And you'd normally be expecting to expand. So let me show it you this way. We lost almost 22 million jobs in a couple of months. Great. We're now down by just 2.8 million. But if we'd have continued the trend that ended in March, well, actually February, when COVID-19 kicked in reality, we're actually still down by almost 7 million jobs because it's that lost potential situation. So yeah, we're healing, but there is without a doubt a long way to go. A lot of our brokers, there are two things they ask me about. One are mortgage rates and the other one is inflation. So here's my forecast for inflation going forward. Now, again, given what happened in the Ukraine this morning, I'll probably be revising this somewhat, but I still believe that the total inflation rate peaked in the fourth quarter last year. It's going to slowly, very slowly trend down. And it's my forecast through the end of 2023. And it's still going to be above that 2% average that the Federal Reserve likes to see. But they tend to look at the core rate of inflation, which excludes food and energy, both very volatile sectors. And I think we're going to peak in this quarter, again, before starting to trend down. Now, is this a good thing? Well, dropping, it's only pulling back, it is a good thing, but it does mean the Federal Reserve will raise interest rates. Meeting coming up next month, I guarantee you that they will raise rates. My forecast right now is that they will raise them 5 times this year. However, the issue has come up because of what's going on with Russia and the impacts on the oil sector more than anything else. Russia is the 3rd largest exporter of oil on the planet. And if we see the oil prices continue to rise, we broke $100 a barrel today, then that might give the Fed some pause for thought. They might say, maybe we just don't have to get that aggressive in trying to tame inflation. But the bottom line is we will see a Fed funds rate increase, and that's going to have impacts all the way along the yield curve in terms of people's ability to borrow money. However, are we going to go back into the old days of the late 70s, early 80s with stagflation or inflationary spirals? I don't see it. And here's why. You kind of have to bear with me just for a second on this. So if you look at CPI inflation, total year over year, almost 8%. The core, minus food and energy, about 6.2. But let's take a quick look at used car prices. I kid you not. And this is just the month-over-month change in used car prices. Really quite extraordinary. They're not ceasing adjusted, so you can see some drops. But annualized, since the month before COVID-19 kicked in, almost 26% year-over-year increase in used car prices. So why is that important? Well, we know core CPI is 6.2, but you need to really look at it on an annualized basis going back to the month before COVID-19 kicked in to get better perspective on what's happening. And when you do that, well, 3.7, not good, but not as bad. Well, let's take out used cars. What does that really mean? Well, Gardner's rate of inflation today, 3%. So is it that bad yet? No, it's not. And I think that we're going to continue to see issues, certainly in the car industry, mainly because of what's going on with Russia and Ukraine, because they are two major exporters of some of the materials needed to make semiconductors, so computer chips. And that's the reason why we've seen such a low number of new cars being built in the country the last couple of years. That's what put upward pressure on used car prices. So I don't expect us to see 10, 12, 14% inflation, but so much of it is still being driven by supply chain issues and because of COVID. So my big picture US forecast variance. I'm an economist, not an epidemiologist, but I know more about this bug than I would ever wish to. Now, are they still impacting us? Yes, but as I said in forecasts back in December when Omicron was starting to come on the scene, I really thought that we were going to go the same direction as my friends back in the UK. Significant spike, but then a massive drop very quickly. And that indeed is what's happening. So assuming we don't see even more, there are still a lot of letters left in the Greek alphabet, but hopeful that won't be the case. The impacts are going to start slowly, start draining off. Hiring is hard. It's both in blue collar and white collar sectors. And companies need to hire people. They're raising wages to attract them, but are also having to raise wages because of the inflationary environment. Now, on the white collar part, that's important because it can act as an offset to mortgage rates, which I'll talk about momentarily. Build Back Better. It's I think, a very solid plan. Our roads, our bridges, you guys know this being up in Skagit County. What happened when that bridge decided to get hit and fall down? They need repairing. And if we do get this passed, it will be a, for want of a better word, shot in the arm for the US economy. Will it? I don't hold out much hope, quite frankly. The reaching across the aisle in Congress is near as damn it impossible these days. So I'm not going to hang my hat on it happening, but if it does, it will certainly change all economists' forecasts for the good rather than the bad. Yeah, Ukraine, an unknown. And obviously the president spoke today. There'll be more sanctions implemented. It's going to take quite some time for those to potentially get some traction on what's going on there. It is an unknown, and as we all know, markets don't like uncertainty. And what happened this morning? The stock market tanked, yet by the end of the day, it had recovered all of its losses and some. So there's still a lot of skittishness going on, given what's happening in Europe, and the potential for this to be potentially a most serious event in Europe since the end of World War II. All those things being said, and trying to be on a somewhat positive note, I still stand by my belief that we should be back to a somewhat new normal. Believe me, we're not going to go back to where we were in 2019 anytime soon, but it will be a new normal likely by the end of this year. All right, so that's the US economy. Now let's talk briefly about the state economy and our labor markets. This looks at the number of jobs lost and recovered, jobs lost due to COVID and those recovered. And as you can see, Seattle, obviously by far the hardest hit, lost almost 218,000 jobs, back about 163,000. As we move down that list, numbers become a bit more interesting. Wenatchee has basically recovered. Longview recovered all the jobs lost, as has essentially Kennewick. You're down by a couple of thousand right now in Skagit County. but it is doing better. And what's particularly interesting about your market is this. When COVID-19 kicked in, you actually had the highest unemployment rate of any metropolitan area in the state of Washington. But look where it was in December. I would say one of the lowest, but down there below 5%. Did get hit very, very hard, but has certainly come back very, very well. Now, yes, these are December numbers. The state is notorious for delaying the January data. We should get it, I think, in about a week and a half's time. And I would expect that number of 4.7 to be down probably closer to 4.4 in January. So are we seeing an improvement? Yes, but there are issues with that as well, which we will get to now. On the labor side, we know you lost a ton of jobs. It's a small economy, basically. So you tend to see not that much in terms of significant changes, but you're still adding jobs. And again, when you look at it on an index basis, well, it took you longer to recover all the jobs lost during the financial crisis than the country as a whole. We are doing better, but there are still some shortfalls. What are they? Government and hotels, bars, restaurants. But you've basically got all those jobs back in the leisure and hospitality industry, most back in government. And as you go down that list again, you've got transportation. And that is, thank you, Amazon, more than anything else. Transportation, warehousing, utilities, modest contraction, but has recovered very, very nicely. So you are getting there, but it is just taking some time, as it is across the country. Unemployment, I showed you 4.7. Again, the trend is going down. But here's the problem that I have with your market. Labor force, it has not grown. They're in essence somewhat fewer people in your labor force, civilian labor force, working age residents, in December of 2021 than there were in January of 2020. So you're not seeing any expansion in the labor force. That's going to be a problem. That's going to be a problem because it means, to me, businesses want to hire. Who can they hire? And that is an issue. I mean, you're down below, the number of unemployed people today is below that we saw before COVID-19 kicked in. So when you combine that labor force and the number of unemployed people, that makes it very hard when you start thinking about growth going forward. Yes, you've recovered a majority of the jobs that were lost. Absolutely. 3,000 jobs were added last year. But this year, it's going to be not that many. And only for the fact that it would be more if there were more people available to work. That's your labor force issue that you have today. Will it improve? Yes, it will. But we just need to improve that labor force. And that's the biggest concern that I have. So labor shortages, yes. Downward risk to growth, there's no doubt about it. However, from a business perspective, Amazon, Roxy and Cascade are the two big projects. That would produce about 1,000 jobs in Arlington, a few hundred, they haven't defined it, in Burlington. Obviously, the Cascade Business Park, which is where the Arlington project Roxy is going to go. What, 4 million square feet, I believe it is, on 400 plus acres. That is going to be a lot. And that will ultimately generate somewhere in the region of 4,000 jobs, depending on the mix of occupants. So I think that is a positive in terms of looking forward. Can that attract workers to come in from the north, from Whatcom County, or from the south in Snohomish? Potentially, I think that would be the case. Airlines, obviously, Bellingham Airport growth. They've just got Southwest Airlines signed in, the Alpha Air Park. We know what's going on further south in terms of regional airports as well. So there are a lot of things in there which are going to start becoming potentially more attractive to businesses. And without a doubt, all these bode remarkably well when it comes to your economy. So you are in a state of flux. You've recovered most of the jobs that were lost due to COVID-19. You could recover a lot more if there were more people out there available to work. All right, so you didn't really want to hear me talk about the economy. I know what you wanted to hear me talk about, and that is housing. But before we get to housing, we've got to kind of get this one thing out the way, which is the one thing I'm probably, beyond COVID and inflation, Windermere brokers ask me about more than anything else. Now, these are the weekly mortgage rates. Numbers came out today, and you might see that little notch down. And that is purely because of the Ukraine. So we've seen rates go almost parabolic since the start of the year, because the expectation that the Fed is going to move from quantitative easing to quantitative tightening. And that really is running things from 15 years to 5-1 arms across the board. We saw all those rates rise. And that has a lot of people very concerned. But they were never going to stay at those artificially induced low levels forever. The only reason why they could be at that level, very simple. The Fed buying a lot of mortgage-backed securities, buying a lot of 10-year treasuries at very low yields, very low interest rates to keep mortgage rates low. But it wasn't just them. Through COVID-19, because of the fiscal stimulus that was going on, what were we doing? We were squirreling away cash left, right, and center. So our bank accounts were flush. And what did banks do with that money? They invested it. In what? In mortgage-backed securities. So with banks and the Fed stepping back from being serious buyers, well, then ultimately that means that the yield, the interest rate to attract investors has got to increase. And that is certainly what we are seeing. But please, let's just get some kind of perspective here. These are mortgage rates by decade, going back to when the 30-year fix started in the mid-1970s. They are still historically low. I mean, I'm sure no one here can remember, back in October of 1982, mortgage rates were 20%. We still bought houses. Yes, a lot of seller financing, but it still happened. Now, I'm not saying we're going to go back there again at all, but we are seeing it increase, and that does make sense. And my forecast, and some of you may laugh at this, I'm still believing that we will see an average. Now, this is, by the way, X points. So you need to add on a buffer to create the rate which you are being quoted, or your clients being quoted. Excuse me. But we are still going to be trending up. But I really think that this immediate jump that we've seen was mainly because of mortgage brokers getting ahead of the curve. They thought, they had to quote higher rates so that when they locked those mortgages into, when they securitized them, there would be enough buyers out there. So they're really kind of getting ahead of the curve to the better degree. It wouldn't surprise me to see rates where you're seeing them today actually come down a little bit. However, the trend will be increasing. And I will tell you one thing. I know this is just one economist's perspective, but I have an occasional happy hour, Zoom happy hour, with some friends of mine, and they happen to be the chief economists of this lot. And interesting group. And we exchange our notes and our thoughts on what's going on with mortgage rates. Now, this is going to be the annual, not quarterly, annual average. Fannie Mae, well, he probably had a couple of too many cocktails in our last one. So he is on the low side of the equation. Mortgage Bankers Association, notoriously depressing. They're on the high side. But we are all within a pretty tight range. I think the annual average for this year, 385, and just above 4 next year. So yes, they're rising, but the jump that we've seen recently is an anomaly, and it's very unlikely that it certainly won't continue at that same rate. And given what's happening in the Ukraine and that little notch down we saw over the last week, well, you tend to have, when there's geopolitical turmoil, there's a flight out of equities and into fixed income, into the security of bond debt. And we'll see more people be attracted to that. And as they are, then the prices rise and the yields drop. And that means that rates, won't surprise you if they actually pull back down for a while until we get more clarity on what's going on. But ultimately, rising mortgage rates, they have two impacts. Obvious one, yes, a disincentive for home buyers. Why? Well, for every 1 percentage point increase in mortgage rates, that decreases someone's buying power by 10%. So it's 1 in 10 rule. It's a very classic rule. And that ultimately will act as a headwind to price growth. But I also, what no one's talking about and concerns me more is it can be a disincentive for sellers. So bear with me on this one just for a second. Imagine the year is 2025 and you are sat in your home on a 2 5/8 mortgage and rates are 6.5%. Are you going to sell and lose that never seen before, never seen again rate? I think you won't. And that means one thing. It's going to mean the housing market could stay tight a lot longer. So we're not seeing that churn, that turnover of existing homes that you would expect to see, because no one in their right mind would want to give up a sub 3% mortgage rate. So it's going to be interesting to see how this plays out over the course of the next several years. All right, regionally, and here I just took 4 counties up in your neck of the woods: Snohomish, Whatcom, Skagit, and Island. Transactional velocities. Snohomish County is certainly by far the biggest, but we saw increases. But what's interesting here, Island County, our friends out in Camano Island and Whitby, significant growth after a couple of years actually of transactions dropping. But in Whatcom County, Skagit County actually saw a contraction in sales last year, and that's supply side driven. But more so, I want you to look at this, pricing. Now, pricing, I mean, you saw your market increase by over 18% in terms of the median sale price last year. Not quite as heavy as you saw in Whatcom and Snohomish, but anytime, I don't want to be in double digits, or at least the teens, let alone the 20s, which is what we saw. Now, what was going on? We saw a lot of people start to move out of King County into Snohomish County for the better part, but they're also looking further north into Island and to a degree Skagit. Less so Whatcom, obviously. Why were they doing it? Well, they can buy a lot more house for the money than they saw in King County. Now, the bottom line here is that when COVID-19 kicked in, the ability to work remotely, a lot of people thought, everyone's going to disappear. No, we're not all going to move to Yakima. It's not going to happen. For a majority of companies, it's going to be, the work from home is going to be a blend of part-time in an office and part-time from home. So that's going to limit how far out you can move. But we have seen it happening, and yet the demand and therefore the pricing in your markets is significantly higher than we saw, without a doubt, in King County. So we are seeing that increase because of relative affordability. Price in 2021, median price, again, median, not average, was knocking on 500,000, 5 to 550 in Whatcom, Skagit, and Island. More than that, almost 700 in Snohomish. So we are seeing the fact of these people are moving. So we are seeing those transactions occurring, and a lot of them are coming out, not just from King County. We're seeing people move from California. California lost population last year. Never happened before. Why? Climate change and taxes. They're jumping on I-5. They're heading north. The silly ones are staying in Oregon. The rest are carrying on up to our neck of the woods. And if they're coming out of the Bay Area, they'll look at home prices here and say, I'll buy 3. They are, relatively speaking, so remarkably cheap. So when you combine all those things in concert with where we saw mortgage rates last year, shouldn't be a surprise to see that kind of price appreciation. But is that sustainable? No, it is absolutely not. So looking at Skagit, now I like looking start with population. Interesting, you really haven't seen, number of births has been dropping the last 3 years, no big surprise. You saw an uptick in the number of people dying. Thank you, COVID. So when you do births minus deaths, your net growth, you actually lost population, 45 people, i.e. births minus deaths. But let's look at the slight uptick we saw, big drop in net migration in 2020. But 2021, we did see an uptick. Now, these are numbers from the Washington OFM. They're not the census numbers. I'll get those hopefully by August. It's going to take a while, but it's at least a base point to start with. You saw a massive buildup in people moving into your market from 2012 up until 2019. Saw a drop off then. However, it has turned back up again. And that really does start to explain a little bit as to why you've seen the kind of price appreciation in your market that you have. All right, existing homes. One of the biggest annoyances I have when I'm interviewed by the media, mainly after the Northwest Multiple releases their numbers, is they always focus on the number of active listings. Say, oh, it's woefully inadequate. And okay, yeah, 94. Now, if you're a broker, you say, well, hang on, Gardner, that's wrong. I adjust my numbers for seasonality. So otherwise it looked like a massive sine curve. But the bottom line, it's been trending down. But what people don't talk about that they should are the number of new listings. New listings should not be above active. It shouldn't work that way. It means that the market is unbalanced, and that's where you are. So when you see that many more new listings than active, what does it mean? Well, it means that our brokers are up there, their home comes to the market on the 5th, they sell it by the 15th. That's actually not counted under the active number, which is a number taken on normally the first or the last day of the month. But new listings are the ones that I tend to focus on. That's the number of homes that came on the market during the course of that month. Another thing I'd like to look at, people look at sale prices. They're a lagging indicator. list prices are a leading indicator. Because when you start seeing some fluctuations there, that's going to really describe the market. Now, here in King County and in many other markets, we've reached the apex. We've seen list prices start to pull back a bit. What's going on? Well, home owners and home sellers have been pretty much used to the last couple of years getting whatever they want for their homes and pushing prices and pushing prices. Now, we did see a drop a few months ago, but the average jumped up to now over 950, 550 on median. Again, median is a better way to look at it. But the trend continues to rise. We haven't seen that inflection point yet. And so we know that prices are rising and they can continue to rise because of this. Because long-term demand, on average, going back to 2000, about 1,400 single-family resale homes are sold in Skagit County every year. Well, you've been above that level now for, well, really since we came out of the housing bubble bursting, which you can clearly see what happened then. Very, very robust. And you've been seeing turnover. Another way I like to look at it is how long are people living on average in their homes? Well, you guys last several years, about 8.5 years on average, down 6.5 now. That massive drop really talks to the number of transactions that occurred. More people starting to move on. On the sale price side, now this is really fascinating. If you bought your home in, let's say, January of 2012, which would be the absolute perfect time, by the way, your home price has almost tripled in value in that time. That is an extraordinary, extraordinary number. So even through the ramifications we saw post-housing bubble, then the build-up that we saw after that point, a massive increase in pricing. And we know that. So average median prices up very significantly year over year. Can this continue? No. I mean, your average is above 10% 2020, or was 20% last year. So this is good and it's bad. Is it good for existing homeowners? Oh, you bet there is. No doubt about it. Why do I know this? Well, over 60% of you, if you live in a home and you have a mortgage, have more than 50% equity in your homes. That is an amazing number. And you can naturally see what happened as mortgage rates dropped through this point here. Massive increase in home equity. If you are a home buyer, however, this is causing you conniptions. Homes that you thought at one point you could afford to buy, maybe not. But there's something else that always comes to mind when you start seeing this kind of rabid pace of price growth. The old school brokers out there will know, oh, this reminds me of 2006 and 2007. Are we in the same situation of a housing bubble bursting again? No, we're not. And here's why. So this goes back to 2000. Median home prices, okay, yeah. Have they risen? Sure. You see the boost, the bubble forming, the bubble bursting and up. And prices in that 21-year period are up by over 250%. But what happened to mortgage rates during that same time period? Yeah, they were above 8 and they dropped down to below 3. So remember what I said about the ability, so if every 1 percentage point increase, that decreases your buying power. Well, the same thing applies in reverse. So we're able to see that significant increase, a lot of it based upon the fact, and especially if you look starting probably around 2019, this massive drop basically caused this to go on. One of my jobs at Windermere is to find bubbles, find bad things that could happen in the market. And that's what I spend my life looking to do. Years ago, I read a book by a guy, Bob Schiller. You might know him from the Case-Shiller Index. If you're close into the housing market, you'll know that that is a fairly popular index out there. Anyway, he wrote a book called Irrational Exuberance many, many years ago. And what he said in that book was that what you really need to do to understand home prices is to adjust them for inflation. Now, actually, that does make sense. If you think about it, the value of $1 in 2000 is a lot different than the value of $1 today, right? So I thought about it and okay, I'll do the math. So I did. And so we know 253.6%, that's nominal, unadjusted for inflation. But when you adjust it for inflation, prices are up, but only by 120%. So half of the growth. That actually sounds pretty good to me. But let's take it one step further. Let's look at what the average mortgage payment would be over that same period. So on a nominal basis, you're paying twice as many dollars for a mortgage today as you were 21 years ago. But what would be the mortgage payments on those inflation adjusted sale prices? 31%. In fact, adjusted for inflation, the payment today is significantly lower than it was during the peak of the housing bubble. So again, I look at my job's try and find bad things. And I look at these things and I try and find them, and I'm just not doing it. Can we sustain the pace of price growth that we've seen? No. There must always be a relationship between incomes and home prices. We broke it, and it can get broken. Thank you, Federal Reserve. But it cannot continue that way forever. And affordability is becoming a significant issue. I'm getting ahead of myself. But anyway, months of inventory, your market is balanced when there's roughly 4 to 4.5 months of inventory at any one time. That would be the number of homes on the market divided by the number of pending sales in that month. It shouldn't be 3 weeks. And that's where you stand, or it's where you stood rather, in 2021. And taking a bit longer to sell now. But again, these are not adjusted for seasonality, so don't be surprised. January, remarkably low inventory. What's going in the market may not be the best homes out there, shall we say. It's a bit longer, but again, the trend is still low and significantly lower than we saw back just 2 months before COVID-19 kicked in. When we talk about prices going up, it's wonderful. If you own your home, you're seeing all this equity build up, that's wonderful. But there's a problem with it. And the problem is this. At UW, we created a housing affordability index back in 1994 for all the counties within the state. And we still count today. And these are the latest, greatest numbers that haven't been released formally yet. You get the first look. And so what this means is the ability for a household in Skagit County making median income in that county to afford to buy a median priced house. You were affordable in general until about 2017. Then notched down, it came back up again a bit in 2020. Why? Because mortgage rates dropped, but it has dropped down significantly. And given the fact this is through Q4 and knowing where mortgage rates have trended for the first month and a half of this year, that number is going to pull back down again. But look at first-time buyers. The last time it was technically affordable for them was back in 2012. That is concerning. Now, when you look at it in this respect, are homes selling? Sure. But what would be the technically affordable price? Well, for all buyers, it would be $429,207.32. No, it's roughly that much. So, and that was in the fourth quarter. How many homes do you think were on the market that met that threshold of being technically affordable? 105. That is it in the fourth quarter. That's the number of new listings. But what about first-time buyers? Yeah, not a lot. So it is going to be very hard for those first-time buyers to get their first foot on the rung of the ladder. We know they want to. Millennials, big component of our society in general, and they're getting old. And they're moving away from casual hookups, and they want to get into real relationships. And yes, 70% of them want to buy a home. They believe that would be the most astute financial investment they will ever make. The trouble is, what can they find that they can afford? It's very, very hard for them. And it's being made harder because of the fact we're just not building enough. I'll talk about new construction momentarily. So it is hard for those first-time buyers. Now, are they buying? Sure. Why? Well, in essence, you have to think about it this way. You have to look at median income for the county, yet people live in the county but work outside of the county. They can be coming south or north. They can be in environments where their salaries are that much higher. But it is still an issue. And I am concerned about the fact of what can our younger generation be able to afford as we move forward. Forget about today. Let's look at 5 years from now. It's hard. We know prices have been going up. This is just within your particular Skagit County MLS areas. This is the annualized change in median sale price. I mean, concrete, well, that's bizarre. It's a very, very small market, obviously. But look at that with 23%, 14, 17, 11, 16. Lacona, Mount Vernon, 23%. These are real numbers. That's why I love math. And that's why I love being an economist, because numbers don't lie. And I looked at them and went, wow, this is really, really quite extraordinary. But can this pace continue? Well, in all these markets, this is my forecast for home price growth this year. It's lower, but it is still very, very significant. I ran the model last week, and it spat out these numbers, and I looked at them and went, that cannot be right. So I ran back and checked all the math and checked all the calculations, and yep. He said, yes, you are certainly going to be coming off, but in general, these markets are still going to be in those teens for the better part. Again, concrete's anomalous for the better part. It's such a small market, you never know, it can be skewed massively. But excluding that, yes, it's dropping down into the low to mid-teens, well above the long-term average, but it's still very impressive. But for the county as a whole, and I'm really kind of hedging on this one, I'm giving you a range of where I think price growth will be in 2022. And really, quite frankly, it's for one simple reason. One, it's a broader data set rather than looking at individual markets, but it is the question of geopolitically speaking, what's going to happen? How's the Fed going to act? Are we going to see any more iterations of COVID? There's a lot of things out there which really kind of lead all economists to drinking heavily, because there are uncertain things that we just cannot forecast. However, that said, prices are still going to be up by double digits this year. And that is remarkably impressive. Now, yes, they're going up, but a mortgage rate's going up. But is that really that important? Well, let's look at it in a slightly different way. Median sale price in January, 530,000. Okay. Well, let's say you got a mortgage to buy that home, and you got the mortgage rate on that date on the last day of last year, which was 3.27%. And let's say you got the mortgage rate, which was today, 4.17. So what does that mean? Well, your payment, Xing out taxes and insurance, this is just P&I payments, $1,850. That increase of 90 basis points, almost a full percentage point. Yes, it went up by $230. So we're not talking a massive amount. So yes, when you're starting from such a remarkably low basis, you can see these jumps in rates, but in essence, its impact on the dollars is not that significant. Let's look at it in a slightly different way. Again, taking that sale price, apologize, wrong on that. $120 if rates rose from 3.5 to 4. If they rose from 4.5 to 5, 128. However, that 3.5 to 5, that's when it starts becoming more influential. So these marginal increases in price, I'm not worried about, yet it will slowly erode into people's buying power, and ultimately that will bring down the pace of appreciation you've been seeing. Why are prices going up so much? Good question. Well, we know mortgage rates have been dropping, but it's a very simple supply-demand imbalance, more demand than supply. How can we fix this? Build more. But there's a problem. You're not. Last year, you pulled in the county 219 single-family permits. That was it. Last week's that kind of number was back 2012, but 2011. Horrible, horrible numbers. It is sad. And what's going on there? Land costs escalate. Land is becoming even more expensive. Labor costs escalate. No one wants to become a plumber, carpenter, electrician. I mean, my son is useless. I mean, he couldn't hammer a nail in straight for love nor money. It's STEM subject. So no one's getting into the trades, pushing that up. Material costs. Last year, lumber prices alone, the increase in them added $36,000 to the cost of a new home. So in the last 3 months, it's been another 18,000. So steel, copper, aluminum, PVC pipe, which by the way tracks oil prices. So you know pipe prices are going to go parabolic because we broke $100 a barrel on oil today. So all these costs in concert mean one thing. Builders want to build, but where they are building, they're building to higher price points where they can get some kind of return. Yet where is all the demand? At lower price points, which they're not building to. And from a demand perspective, there's about 35,000 owner-occupied housing units in the county. My forecast, tentative forecast, again, I'm waiting on the numbers to come back from the census, 5.5%. You'll need at least 1,800 new owner-occupied housing units in the next 5 years. Given that number of permits, you're not even close. So if you limit supply of new construction, you still have demand. What does that do to the price of existing homes? You got it. Makes them go higher. 17 homes on the market, again, unadjusted for seasonality. So next to nothing in terms of supply. You didn't exceed your long-term average in terms of sales last year. Again, new construction is not helping. But I mentioned about price. Well, here's why. Look at that jump you saw, over about $150,000 in the change in average sale price between 2020 and 2021, pushing it up. And we also know that they're building smaller homes as well. How do we know this? Look at the price per square foot. Again, gone parabolic. So yes, you're seeing some construction. Is it enough? Absolutely not. And when you're not building enough, obviously that puts upward price pressure on existing inventory. Your share of sales last year, a new versus resale, 7.5, low. Haven't seen that since before the housing bubble burst. And there's normally people will pay in Skagit County about a 20% premium for living in a new home over a used one. It plummeted through the pandemic, but it's starting to come back up to that level again. So builders are building some, not enough. They're not putting enough permits. What they are building is going to be expensive, and that is just not helping the environment. And that, again, allows home prices to continue for the time being to grow at a faster pace. Forbearance I get asked about as well, and that is, I think, a great program. FHFA put it in when the pandemic kicked in. Basically allowed you, if you were furloughed from your job, to not be foreclosed on, live in your house, not pay the mortgage. However, when you come out of forbearance, then you've got to make the bank whole, either by refinancing or by extending the term of your loan. And there were home buyers, and certainly Windermere brokers across our footprint were saying to me that, now, Matthew, I've got this guy out there, he wants to buy somewhere, but he's going to wait. He thinks that all these homes in forbearance are going to go into foreclosure and he can pick up a home on the cheap. Good luck. Not going to happen. What do forbearance numbers look like in your neck of the woods? You peaked at 7%. Now, these numbers are delayed. Most recent data I've got is, I get my data from the Atlanta Fed. It's a almost 4-month lag. So I would say that September number of 1.8 today is going to be closer to 1% if it tracks the same way as we see across the rest of the country. So yes, there are still people in there. However, how many of them? Well, let's break it down a bit further. Anacortes, this is back September, by the way, 42. Mount Vernon, 132, Sedgwick Willey, 133. I mean, so we're not talking about huge numbers. And again, for the better part, people really misunderstand the fact that there are people in forbearance who are still paying their mortgages. They took it as an emergency backstop, a just in case. So anyone out there that's waiting for foreclosures to act as a tsunami and flood the market, not going to happen. I just don't see that occurring at all anywhere in our region. Now, parts of the Midwest, Texas as well, and parts of Florida, yeah, there are certainly issues there. West Coast, really, it's not the case at all. All right, so that's Skagit. Briefly touching on North Snohomish County, similar situation, unbalanced market. Look at active versus new. Doesn't make much sense there. Yet sales very robust, above that long-term average for the last 7 years. Pricing, similar way to you guys. I mean, you've seen prices triple in the last 9 years. And I mean, now you used to look at this and say, well, hang on, Gardner, that can't be right. I took math, and you can't have the median above the average. Actually, you can, because it means we're actually seeing a movement in the distribution curve of pricing. So actually, it can happen. Doesn't happen that much, but or often, but it can occur. But we saw in North Snohomish County a massive increase. 2 weeks of inventory. Now, again, that should be closer to 3 months. Takes about 2 weeks to sell. So again, that North Snohomish County, where are these markets? So let's look at Arlington, 20% last year. Darrington was 40. Marysville, 25. Lake Stevens, 30. Granite Falls, 22. These are just amazing figures. But when you look at it, if you look at Darrington, look at Granite Falls, and to a degree Marysville, $500,000, that still, in essence, is still cheap regionally speaking. So we are seeing that occur. And for my forecast, well, up in the 17s. I wish I could say it would be lower than that. I just don't see that being the case. And a lot of it is going to be because of relative affordability. when increasing in mortgage rates doesn't have as significant an impact as, let's say, you're living in Yarrow Bay or Hunts Point down here. So it's a very different environment. So when I think about your market, what do I really see? I would be surprised if we're going to see a big jump in the number of listings. I just don't see any reason why that could occur, at least not enough to meet demand. And therefore, you are going to see price appreciation at above the average. Work from home is interesting. What we are finding is people who have the ability to work from home, maybe their home is not suited for it. It's not set up for it. Now, we shut down our offices here on Friday, the 13th of March, 2020. I worked from my dining room table for 9 months. I hated every minute of it. Not my world. Thankfully, I'm back in the office now. But what people are looking for in a home now has changed, and something's coming now far higher up in their requirements. There's several things, one of which, though, is a dedicated workspace. Also, room separation. They're looking for more of that now than they ever used to. Good open outdoor spaces, increasingly important. Now, if you're a home seller and maybe you don't have a study, well, what are home sellers doing today? They're creating dedicated Zoom spaces. You would have no idea the number of interviews, television interviews I did through COVID, where the reporters were interviewing me from either their cars or their bedroom closets. I mean, this was CNBC. I mean, you thought they could afford something a bit better than that, but that's what was going on. So given the fact that work from home is not going to be a all or nothing thing, it's going to be a blend, I believe, for most workers of a few days a week in the office and the balance at home. That is going to imply the fact that people are going to now look for something that's better than their kitchen or their dining room tables. So again, what people are looking for, also broadband internet access, that's become increasingly important now as well, for the obvious reasons. So I'm not seeing a massive jump in demand of new ones coming in, depending on where they work. It'll be very hard for somebody, I'll give you an example, Amazon down here, who haven't actually formalized their announcement on work from home. But the rumor has it is that yes, you can, but you need to live within 1 hour of the office. Well, that then kind of draws a line around Seattle, right? How far you can go and still meet that criteria. But that's not applicable to everyone. And will we see a big jump in Skagit County? Not so much. You probably see a bit more in North Snohomish County. But what people are interested in buying certainly has changed. Space is now even more important. Average home size have been shrinking the last 15 years. Now they're getting bigger again. And you can blame COVID-19 for that as well. Second homes. It's not just second homes, but even primary homes. When you see inflation occur, one thing tends to happen, and it has done historically, the greater interest in buying a home, because home ownership is a hedge against inflation, because you're borrowing at a fixed financing cost. So that, I think, is something which, if we continue to see inflation stay elevated for a while, which I think we will, is only going to potentially continue to drive that demand as people are looking to find a way to bet against it. And owning a home, without a doubt, is that case. Second home demand, yes, was massively robust in 2000 because of COVID, and in 2001 as well. Jumbo financing rates did drop significantly, but your waterfront is getting expensive. I mean, the average home on the market today, waterfront, was priced at about 1.27 million, I think. Medium is about 725,000. So, but supply is remarkably limited. So yes, there will be demand. Yes, it's getting spendy, but people, they will do that. And the second home market was created for the better part through COVID as a long-term alternative to hotel-based vacations. And it's happening up there, but where we saw it most, believe it or not, was out on Pacific County, out on the coast. They were selling homes left, right, and center to people who may well be there a couple of days a month, maybe. And so that second home market is, I think, robust. So financing costs have risen, but more importantly, as a hedge against inflation, don't be surprised if we continue to see solid demand for second homes. And price growth this year, yeah, I just don't see any reason why you'll drop down in single digits, even though rates are going to continue to appreciate. Even if they rise above mine or my colleagues' expectations or our forecasts, I don't think it's still significant enough to act as a massive damper on price growth. But can we sustain home prices growing by more than 10% per year? No, we can't. And I would argue that this year is likely the last year we'll see that before we head back down to a more normalized environment, which in Skagit County and even in Snohomish County as well, is somewhere in that 5.5% to 6% range. Trouble is, you won't do it this year because of more demand coming out as people watch rates rise. They're going to get off the fence sooner to buy somewhere before they rise even further. Hedge against inflation. We're not seeing enough new construction occurring to offset that population growth. And so I would say that it's going to be a solid market this year. You will see transactional velocities above the long-term average, but likely not above what you saw in 2021. Prices increasing in those mid-teens level is pretty much what I would expect to see. And if you are a home buyer out there, I know it's been very hard. I know you're suffering buyer fatigue, but hang in there. You really should, because your broker will find you a home. I promise you that you're going to love, but I know it's tough. It is a very tight market. And I'm afraid this year is going to remain a home seller's market. So in closing, hopefully you've found something interesting in my comments. Don't see a bubble. We will see pricing, affordability, and rising interest rates act as somewhat of a headwind to price appreciation. But quite frankly, I'm not worried about a significant slowdown in price growth until we break north of 5% in terms of 30-year fixed. And no one is seeing that anytime soon. And with that, I will be delighted to answer any questions that you may have. And I will shut this down so I can see all your faces again.
Thank you, Matthew. That was awesome.
Hopefully. Good.
If anyone has a question for Matthew, feel free to unmute yourself, ask the question, and we'll see what kind of answers we get.
Come on, Dawn. I know you're going to ask something.
Well,
I'm not, but I'm going to say thank you because that was phenomenal. Thank you so much. You always help me so much figure all this out. Thank you.
Thank you.
So Matthew,
yes, sir.
We've been upside down with the supply and demand forever, and part of that is due to the lack of new construction, which you just went over. Do you ever see that problem ending, getting better? Are the builders and developers going to catch up to this need?
I think it's going to be a long time, and there's a couple of reasons why. As you are all aware, or at least the brokers here are aware, the state of Washington created urban growth boundaries back in 1990, ratified by all 38 counties in 1993, which basically said, here's where you can build, and outside of these boundaries, you can build one house per 5 acres or one house per 20 acres. End of story. That's it. And so we have a finite amount of land, and we also got a lot of mountains and a lot of water. And so we don't suffer we suffer the issues you don't see in Ohio or Texas, where they just land as far as the eye can see. And so when you limit land supply, what does that do to prices? Land prices, it pushes them higher. Material costs, yes, we're still suffering from supply chain issues. Don't see those improving anytime soon. There are fewer people building homes today in America than there were in 2005. Yeah, literally. No one wants to get into the trades. That increased those prices as well. But as important, I would argue, are fees, regulatory fees. 25 cents of every dollar it costs to build a home are fees. Permit fees, water, sewer, hookup fees, entitlement fees. So we're in a situation today whereby in the state, and as you mentioned in your introduction, I do sit on the governor's board of advisors, and I've been screaming at Governor Inslee for years we need to figure out housing, because we have this missing middle housing. Now, those are households making 80 to 120% of median income. Those are the nurses, the firefighters, the teachers. Good luck finding a home. They are critical to our communities, but they can't afford. So then we end up having rent-burdened households. We know rents are rising significantly today as we came out of COVID. As far as building goes, where we are seeing construction, they're building to the luxury market. Showed you that in Skagit County on one of the charts earlier on, because that's what they need to do in order to make a margin. Now, Were builders building back in 2005? Sure they were. What's different between now and then? Back then, OPM, other people's money. They were massively over leveraged. Well, today a builder, he can borrow 62, 63% of total cost. That's it. He's got to have skin in the game, and he's being very cautious because of it. In fact, across the country, you're seeing the number of homes for sale rise, which is good. But here's the kicker. There are homes for sale that they haven't yet started construction on. And home buyers don't want to wait 120 days. But more importantly, a lot of builders are saying, I'm seeing my costs going up. So yes, I will build you this house for this amount of money. But if my costs go up, I'm going to pass that additional cost on to you. I don't know anyone that would agree to that at all. And so given the fact we are continuing to see demographic growth, think millennials, they are the largest demographic in America. There's more of them than baby boomers. And in the country, about 9 million are turning 30 this year. So they're getting old, and they do want to own a home. And so we're also living in our homes for twice as long, as I demonstrated to you as well. We're not moving for our jobs as frequently. 20, 25 years ago, looking for another job, find one, great, kids, dog, car, off to Ohio we go. Where we're changing jobs, we're staying in the same location. So we're not seeing that turnover, that churn of existing housing. So all those things in concert with each other tell me one thing, and that is we're not going to increase our urban growth boundaries. There's no political will to do that at all. We have some discussions going on in the state legislature. I spent a lot of time in Olympia arguing and screaming at senators to fix this on changing single family zoning. But unfortunately, the proposal was put forward, House Resolution 1787 failed. And that would allow the building of development of duplexes or triplexes inside any single family zoned area, as long as it was within half a mile of mass transit. It's a ripoff of a plan already in place in the state of Oregon, and one which Governor Newsom signed into law about a month ago in the entire state of California. So they're doing it. It all started back in Minneapolis, by the way, but anyway, but we're just not seeing that here. So it's very, very hard for builders to build to a price that we can afford. And if we're creating households, then we need more supply. And the only way we can address it, Econ 101, bring up more supply. We know what the demand level is going to be. That can start leveling off pricing. I would just don't see it. I pulled the numbers, census numbers from permits for 2021. I was gobsmacked. It was just, I had hoped it would be significantly higher, and it was not. So that is going to be an issue.
I could not believe the low number of permits in Skagit County. That's crazy. So piggybacking off something you said about the rents and how quickly they're going up, we're seeing a lot of investors buying homes. I think of the Zillow debacle with their iBuying, where they had to sell off 7,000 or whatever, but more than that, 13,000 homes, or they're in process of selling those. But a good portion of those homes are being sold to institutional investors. So these are all homes that are leaving the owner-occupied world. Are we going to become a renter nation? Where's our owner-occupied percentage going to end up here?
No, a rental nation, I don't think so. So there's a couple of things which come into play here. I mean, I'm not going to dig into the Zillow issue, although I will tell you that Svenja Goodall's the chief economist at Zillow. She's a dear friend of mine. And when they implemented that program, I called her up and said, what the hell are you doing? It makes no sense. The math doesn't make any sense. They made that decision. And if I'm going to give any credit, because they're publicly traded, they had to rip the Band-Aid off at some point. It didn't work, and it was never going to work, in my opinion. But two things are happening. You mentioned that, but what I'm actually seeing is something different. Yes, and I will happily pull up the numbers for the share of homes traded over the last year in Skagit County that were sold to institutional investors. I have those numbers. But what we are seeing more than that is a lot of investors, because of the moratoria on evictions, they weren't getting rent now. You could actually get forbearance on that loan, believe it or not. But what the tenants were also not doing, they weren't paying the utilities. So these homes are having liens put on them for failure to pay that. So the home owners are saying, ultimately, I don't need the grief. To heck with this. The market's great. I will sell. I put my money somewhere else. But if they sell to somebody that's going to be living in that home, that depletes supply. And that ultimately will potentially lead rental rates of single family homes to rise because there's fewer of them out there. So you've got to be careful about what you ask for in that respect. Do I believe there'll be a renter owned area? I just don't see that occurring. But I said I'll happily pull up the share of institutional investors who bought in your market and share that with you, Nate. But I don't see it's going to be significant enough. But we are on the other side seeing rents increase as investors get out of the market because the ownership market is so buoyant. They can make so much money, less grief from tenants not paying. But again, that deletes or diminishes the stock of single family rentals. Ultimately, that leads rents to increase.
Okay. Raquel McDermott has a question, then Phyllis after Raquel.
Hey, Raquel.
Hi, thank you so much. It was great, Matthew.
Oh, you're welcome. Oh, there you are. There you are.
So I'm going to lower my hand. Quick question. I don't know if you can answer this or not, but as far as the rent is concerned, I've been a realtor for 19 years, and I have a lot of clients that are coming to me now with their 20-something-year-old kids saying they can't buy yet, and we've been looking for things for rent in Skagit County. Why is rent more expensive in Skagit County than it is in Bellingham or even Seattle? Do you have an answer for that?
Yeah, no. I did not know that was the case. I mean, I'm not sure. I'm not sure what the stock of your single family rentals is up there.
Well, we're actually, it wouldn't even compare. Can't find a lot of like rooms for rent here or apartments for rent here in Skagit County. Yet we're finding that because I did some research for them.
Sure.
Seeing more rental options in Seattle and Bellingham, like small apartments, rooms for rent.
Right.
You know.
Yeah, I mean, when you mention the word rental, a lot of people automatically kind of revert back to apartments. And that's really not the case. There's a lot of people that have families that are renters, and they're not going to rent apartments, they rent single family homes. But again, it comes back to that supply demand dynamic. And if you've got limited supply, but people want to be there, they will pay more in rent. And as you said, there are likely fewer options in a lot of your sub-markets there, which tend not to have a significant amount of multifamily development activity anyway. And if that's the case, then yeah, they could go up to north, they could go south. But if they want a single family home and you've got a finite supply, again, that really kind of screams the fact that people push rents as much as they possibly can to achieve that yield. So that's probably is, I think you answered your own question. It's a lack of diversity of supply in Skagit County, which means that the rental rates are going to be higher. It's always going to be likely more expensive to rent a home than it is to rent an apartment.
Yeah. The diversity is definitely a problem here. So
and it really is. I mean, I was giving a speech over in Whatcom County a month or so ago, and I'm trying to talk them into increasing density, even in their downtown market. And the pushback is phenomenal. People just don't want change.
Yeah, there's businesses in Cedar Woolley and Mount Vernon that easily could have rentals above the businesses, and they're just, the space above the businesses is just staying vacant. Right.
Yeah, no, again, it does tell that fact that people need to live somewhere. And certainly as parents, we love that we actually get the kids out from the basement and on their own. And we help them as much as possible in that respect. But it can be very, very hard. And certainly we don't see that diversification of housing stock. And that's the biggest issue you have, because you are very, very predominantly a single family county.
Definitely. Great. Thank you for your time.
Sure, of course.
Phyllis?
Hello, Phyllis.
Yes, hello. Matthew, I just want to thank you for all your wonderful insights into the industry and what's going on. I always enjoy hearing you, but I just want to say, I want to ask, do you think what is happening here with, Putin invading the Ukraine?
Mm-hmm.
Sounds like
what do you think what kind of impact do you think that could possibly have on our housing market? I am very concerned about it, and I'm wondering what your perception on it is.
Right. Yeah, well, it's interesting. I mean, obviously, we know what happened today, and because of that, I've done 3 radio interviews today about that exact topic. Couple of things here, the good and the bad. The bad is oil prices. So gas is going to get more expensive. We broke $100 a barrel on oil today. And that is going to have impacts across the board, because not just the fact we're paying more for fill up a gas tank, it also means that the cost of goods are going to go up, because a lot of our goods are still shipped around the country by road, and that's going to make those more expensive. So it is going to be inflationary in that respect. Secondarily, I'll go back to the car part, is that Russia and the Ukraine are significant creators of parts which go into semiconductors, into chips. So that's going to have an impact on not just new cars, but also in the technology sector as well, computers and these kinds of things. So there are the direct impacts, which are going to be increasing oil prices. It is going to be inflationary. The positive part, and we've already seen it, is mortgage rates. Because when there is uncertainty, people get out of equities and they move into fixed income. So that dropped down. Again, we only dropped by 2 basis points today. So 0.02% on the 30-year. But that's only one day. And as you start seeing, when there's any geopolitical concerns, then people tend to move away from stocks and into bonds. And that is a positive, because it's positive for the housing market, because mortgage rates are set based upon the interest rate on 10-year treasuries. That's really what you do. What you do is you take the yield on 10-year treasuries, you add in a premium, a risk premium, and that gives you where mortgage rates are. And so as there's more demand for bonds, that means that the price of those bonds goes up, the yield, the interest rate drops, and that means that mortgage rates can drop. That's, in essence, the kind of the good and the bad. The ugly part is it's going to take a while for the sanctions that the president announced today to work their way through the system. And this whole situation does have the potential to be the worst conflict that Europe's seen since 1945. So there's a lot of concerns in that respect. So the issue overall would be, it's created yet another uncertainty. It's not helping the Federal Reserve, because if they want to raise interest rates to stave off inflation, this is a problem. It could mean that they're not as aggressive in raising rates going forward. So there are some issues that come into play there as well. Ultimately, do I think we're going to kind of get into another massive conflict? I would be surprised by that. Only the fact that no one wins those things. We all watched war games, right, back in 1984. It doesn't work. But I think that the short-term pain is going to be felt at the gas pumps and in food prices. So food and energy prices are going to be the direct consequence of what's going on there, and a direct consequence to the US. But it is going to mean the Fed and Jerome Powell and Janet Yellen are going to be perplexed as to how fast they want to raise interest rates, given these pressures which are coming to play, which they had not expected to occur. That's a simplistic view of it.
Awesome, Matthew. Thank you. Dan, did you have a question?
Yeah. And by the way, we all love war games. That was a great movie. We all know the direct correlation between the 10-year note and mortgage rates. Is there any correlation at all with the Fed's raising the rates to mortgage?
No, none. No, absolutely not. No, the Fed has the ability to change Fed funds rate, overnight rate. So now it has very modest impacts all the way along the yield curve. I mean, yes, it does. However, I mean, the way the 30-year was created back in 1973 was, you might argue, well, hang on, why does the 30-year mortgage track the 10-year treasury and not the 30-year? Well, it's because we move every 10 years, and that's why that happens. So if you look at the correlation between the yield on 10-year treasuries and 30-year, yes, they can go in different ways occasionally, but over the long term, they work remarkably well with each other. And I said earlier on, what it is, you have to take the yield on 10-year and then add on 1.5, 1.6, maybe 1.7%. And that's the premium you pay for a mortgage over a bond, because there is still some risk associated with a mortgage, yet there is no risk to a bond. So that in essence is how we create mortgage rates. But in terms of the Fed's ability, no, yes, there's some thought goes into it as the Fed raises rates. Sure, there's no doubt about it. But is there a direct correlation? No, there isn't. I mean, not at all.
Okay, Matthew, I had a question come in about the residential stats. Do those include condos, or is that just single
No,
family
single family.
residence? Just single family.
Yeah, I broke it out because you don't have a significant enough condo market to really kind of get to talk about. Given that 1 hour I had, it'd be I just have to squeeze so much into a finite amount of time. So, and because it's a very small condo market up there, I chose to take out that completely.
Okay.
Otherwise, you can't conflate the two things. It would be terrible to do that.
Yes, yes. Does anybody else have a question for Matthew?
Cannot believe you're all so quiet.
We're just soaking in all the information, Matthew, and processing. Well, thank you very much
Sure.
for showing up tonight and talking to this group. We really appreciate you and all the information you share with us. Am I going to be able to get a copy of the slide
I was
deck?
just going to say, so yeah, Lisa will be sending you the deck first thing in the morning.
Okay.
And so you have that. Feel free to share it as you deem appropriate. But yeah,
Great.
no, it makes great bedtime reading. You'll be asleep in a heartbeat.
Perfect. So if anyone here wants either a link to the recording of this so you can watch it again or share it with a friend, or the slide deck, reach out to your agent, or if you are an agent, to your manager, and we will get you a copy of that. Matthew, thanks very much again. I appreciate you. I appreciate all the knowledge you share. And that's it for tonight, everyone. Thank you for being here.
Everyone stay safe. Leave you one thing: where it is safe, please shop locally. Amazon doesn't need your money. Bezos can afford his divorce. But I worry about bricks and mortar retail. So spend your money locally. I think it's going to be a last thing I would leave you with. So with that, hopefully next year, Nate, I'll see you all in person and not do this Zoom thing again.
Yes, that is our goal. In person with some wine and appetizers and an evening out with Matthew. Sounds amazing.
I look forward to it. Stay safe, guys. Take care.
Bye.
Thank you, everybody.
Bye.
Thank you.